Welcome everyone to the fourth quarter equity market outlook and strategy. We continue to see pockets of opportunities in the equity market in the fourth quarter of 2019 on the back of supportive economic policies, stabilising earnings, as well as some reduction in the US and trade tension. Investors should maintain a neutral asset allocation of 50-50 between equities and fixed income by focusing on the diversified global income funds such as REITs and selected growth funds that include China. The World Bank in June has revised the global growth of 2.6% from 2.9%, which was made in January 2019. With global growth moderating, policymakers around the world have implemented measures such as cutting rates to support growth. The Central Bank of Thailand, Indonesia, and India recently eased their monetary policy with 25 to 75 basis points of rate cuts. The US Federal Reserve has also cut the interest rate by 50 basis points as an insurance against the potential slowdown of the economy. In addition, the Federal Reserve stopped shrinking its balance sheet in August, which stood at $3.6 trillion, which translates to more liquidity in the financial system. In the next 12 months, we expect at least 2 more rate cuts in the US. In Europe, the European Central Bank has announced a new stimulus package aimed to revive the Eurozone economy and to bring back inflation. The ECB has cut deposit rates by 10 basis points and will reinstate the quantitative easing program in November to inject more money into the economy. We believe Asia's export-oriented economies will need policy intervention to sustain domestic consumption as part of the efforts to maintain overall economic activity. Inevitably, a combination of more rate cuts and increased government spending to support growth will be put in place. Despite facing challenges owing to the trade dispute, Asia's corporate earnings appear to be bottoming, supported by economic policies for growth. We anticipate the Chinese policymakers to continue to stimulate the economy. This includes, number one, the restructuring of the current tax structure that will return nearly 2 trillion RMB to the economy. Number two, the central bank has cut the deposit reserve ratio to make financing cheaper, aimed to help small and private firms that are vital for economic growth and employment. Malaysia is projected to grow moderately in the second half, owing to softening external demand and government austerity measures. The bright spots are Malaysia export has rebounded unexpectedly by 1.7% year-on-year in July, with the electronics sector being the key export driver. Consensus is generally expecting a mildly expansionary budget for 2020. The budget deficit is projected at 3 to 3.2% of GDP. In Indonesia, the government has launched an expansionary budget of US $177.6 billion for 2020, with GDP forecasts of at 5.3%. Focus will remain on the infrastructure spending, with education as the second focal point. The Central Bank of Thailand has lowered the policy rate by 25 basis points and proposed a $10 billion stimulus to support the farmers and the lower income segments. Moody's has affirmed Thailand's sovereign rating and upgraded their outlook from stable to positive due to strong public and external finances. In conclusion, we see the investment outlook as follows. Number one, we maintain a neutral asset allocation of 50-50 between equities and fixed income. Within equities, we prefer quality and growth names. Number two, by geography, our preference is global to Asia-Pac ex-Japan, followed by single country equities. We anticipate turning more positive towards Asia-Pac ex-Japan equities soon. Why? Because we see earnings estimated stabilizing, economic impact of trade war better appreciated, and the technology sector starts to see revenue growth. Number three, for core portfolios, we recommend funds which are globally or regionally diversified with income focus, such as REITs. Lastly, for more aggressive portfolios, we advise our clients to focus on funds with exposure towards China or the technology sector.